You know, we all think of the great crash of 1929 as this sudden, shocking event, a total bolt from the blue that plunged the entire world into the Great Depression. But what if I told you that for the insiders, the people who really understood how the market worked, it wasn't a surprise at all? See, while the headlines were screaming things like everyone ought to be rich, and politicians were selling the story of permanent prosperity, a very select few were already quietly heading for the exits. They could see the cracks forming in the foundation long before they turned into canyons. For these folks, this wasn't some random accident waiting to happen. No, it was inevitable. They were watching the signals that the crowd was completely ignoring. Things like the Federal Reserve making money tighter, or insiders quietly selling off huge blocks of their own stock. They saw a market that was built on a ridiculously fragile mountain of debt. And that right there is the entire point. For those in the know, the crash was practically a scheduled event. So the real question wasn't if it was coming, but who knew, and what were they doing about it while everybody else was still buying the dream. 1. Euphoria meets the Fed. To really get what happened, you have to understand the massive party that came right before it. I mean, the roaring 20s were absolutely wild. The Dow Jones Industrial Average went up sixfold, 600%, between 1921 and 1929. It honestly felt like the old rules of money just didn't apply anymore, and everyone was going to get rich. And this really shows you the total disconnect. On one side, you've got the public narrative, this idea of a new era of wealth. But behind the curtain, the Federal Reserve was seeing a huge, dangerous bubble. So they started doing what central banks do. They started tightening the screws, trying to cool things off by making money more expensive to borrow. And this was their main weapon. In August of 29, right before the market peaked, the Fed hiked its key interest rate up to 6%. Now this was a loud, clear, public signal. It was meant to be a splash of cold water, to slam the brakes on all that speculation. But the market, it was drunk on profits and pretty much just ignored it. And this quote, wow, this just captures the peak of that delusion perfectly. This wasn't some random guy on the street. This was one of the most famous economists of his time, saying this just 2 weeks before the whole thing came crashing down. The belief in the market was absolute, even as the ground was crumbling beneath their feet. 2. Leverage, the fuse. So if everyone was so optimistic, what actually broke the market? It wasn't just that people had a change of heart. Nope, it was the system's plumbing, specifically a little thing called buying on margin. This was the fuse, and it was just sitting there, waiting for a spark. Let's break down what this meant, because it's so important. You could control $100 worth of stock with just $10 of your own cash. Think about that. It was like rocket fuel on the way up, right? It magnified your profits like crazy. But it also meant that even a small dip in the market could completely and totally wipe you out. And this is where it gets really scary. It created this terrifying feedback loop. A small price drop triggers something called a margin call from the broker. Basically them saying, hey, you need to give us more cash, now. Well, most people didn't have extra cash lying around, so they were forced to sell their stock to pay back the loan. And all that forced selling just pushed prices down even further, which triggered even more margin calls. You see, it wasn't about feelings. It was a mechanical, self-reinforcing death spiral. 3. The quiet exit. So while the public was borrowing money hand over fist to jump into the market, the pros saw this ticking time bomb and started to quietly sneak out the back door. The massive trading volume you saw in late 1929, that wasn't enthusiasm. Insiders have a name for it: distribution. It's the pros selling all their shares to the amateurs who are just showing up to the party. Let's talk about some of these players. You had Bernard Baruch, a legendary financier, an advisor to presidents. He'd seen financial panics before, and he knew exactly what reckless speculation looked like. By the summer of 1929, he'd sold off his stocks and put his entire fortune into the safest things he could find: cash and government bonds. Then you've got a guy like Jesse Livermore, maybe the greatest stock speculator of all time. He didn't just get out of the way. He did the exact opposite. He started building huge short positions, which is basically a massive bet that the market is going to go down. He was positioned to make an absolute fortune from the disaster he saw coming. And here's the most scandalous one of all. Albert Wiggin, who was the head of Chase National Bank, one of the biggest banks in the country, was secretly shorting his own company's stock. He made millions betting against the very bank he was supposed to be leading. Now, believe it or not, that was legal back then, but it just shows you the level of conviction these insiders had that a collapse was coming. And look, it wasn't just a handful of famous guys. We're talking about corporate insiders across the board dumping their own company's stock. You had foreign investors, especially over in London, who saw this bubble from thousands of miles away and started selling off their American assets. And the bond market, the classic safe haven, was getting stronger and stronger. All of these were bright, flashing red lights that the smart money was running for cover. 4. The inevitable collapse. So you've got the smart money out of the market, and the whole thing is balanced on this fragile mountain of debt. At that point, it was just a matter of time. Once the selling finally started to overwhelm the buying, that margin called death spiral we talked about kicked into high gear, and the whole system broke, exactly like the math said it would. And the end came so fast. Black Thursday was the first major punch, but then came Black Monday and Black Tuesday, 2 catastrophic days back to back, where the market just vaporized, falling almost 25%. The panic was on, and all that forced selling from margin calls was just gasoline on the fire. And the pain didn't stop in October, not even close. That initial crash was just the beginning. From its peak in 1929 down to its absolute bottom in the summer of 32, the market lost a staggering 89% of its value. An entire generation's wealth just gone. Histories rhyme, so why are we talking about a story from nearly a century ago? Because, as they say, history doesn't repeat itself, but it sure does rhyme. The fundamental patterns of human psychology, of leverage, of central bank policy, they're absolutely timeless. Just look at these parallels. Back in the 20s, the story was this new era. Today, it's the AI new economy. Simple. The wild speculation that was focused on RCA, the hot tech stock of its day, well, now you see it in big tech and meme stocks. The mechanism of margin buying debt has been supercharged with things like complex options and record leverage. And the catalyst? Fed rate hikes back then, policy shifts today. The costumes have changed, but the actors on stage feel eerily familiar. So here's the bottom line. The biggest lesson from 1929 is that markets don't reward blind optimism. They reward preparation. They favor the people who actually read the signals over those who just want to believe the story. The crash wasn't really a surprise. It was a schedule. And that leaves us with a really important question as we look at the markets today. Are you watching the signals, or are you just buying the story?